there are moments in the vast arena of global finance when a single overlooked asset begins to stir, sending subtle signals to those who have learned to read the deeper currents beneath the surface noise. This is precisely one of those moments, and the metal quietly making its presence felt carries implications that stretch far beyond its own charts, touching the very foundations of the precious metals landscape that many follow so closely. Welcome back to this update on the evolving dynamics shaping gold and silver markets. Today, we explore a narrative that the wider financial media has yet to fully weave together, one centered on platinum's remarkable journey and what it may foreshadow for silver and the broader architecture of supply, demand, and geopolitical realities. Platinum reached an extraordinary peak earlier this year, climbing to approximately $2,200 per troy ounce around late January. That figure stands out because it represented territory untouched since the intense volatility of early 2008, when prices briefly soared near the $2.00 mark before retreating sharply. For nearly 2 decades afterward, the metal experienced extended periods of consolidation and relative obscurity, drifting in ways that led many market participants to shift their attention elsewhere. Yet over a compressed time frame of roughly 8 months leading into that high, platinum more than doubled from earlier levels, surging past multiple psychological barriers in a display of momentum that few active traders had witnessed in their careers. Such a move transcends ordinary commodity fluctuations. It reflects underlying forces reshaping industrial needs, investment flows, and resource constraints on a global scale. Following that apex, a natural pullback has unfolded, with platinum recently trading in the vicinity of $1,900 to $2,000 per ounce, depending on daily conditions. This moderation from the highs does not diminish the significance of the preceding advance. Instead, it invites a closer examination of the structural elements at play and how they intersect with the silver market that so many enthusiasts monitor with great dedication. Consider the contrasting attention these metals receive. Enthusiasts in the silver community often focus intently on the gold-to-silver ratio, scrutinizing its fluctuations as a potential barometer for relative value. They track spot prices with consistent vigilance, watching for signs of breakout or reversal. These metrics provide valuable context, yet they may overlook parallel developments in adjacent parts of the precious metals complex. Platinum's trajectory offers a compelling case study in this regard. While silver commands a devoted following rooted in its monetary history and industrial versatility, platinum has been operating somewhat in the background, driven by specialized applications that tie it closely to modern technological and environmental shifts. To appreciate the full picture, it helps to reflect on the geological realities governing platinum group metals. Unlike gold, which has been mined and accumulated for millennia, or silver, with its dual role in bullion and industry, platinum deposits are concentrated in specific regions, notably South Africa and Russia, which together account for the vast majority of global supply. This geographic concentration introduces layers of vulnerability tied to political stability, labor dynamics, and energy costs in those areas. Mining operations for these metals require significant capital investment and face environmental and regulatory hurdles that can constrain output even as demand evolves. In recent years, disruptions ranging from infrastructure challenges to policy shifts in producing nations have contributed to tighter availability, setting the stage for price responsiveness when industrial consumption picks up. On the demand side, platinum's role in catalytic converters for vehicles has long been central, though the transition toward electric and hydrogen fuel cell technologies is altering the equation. While some sectors may see reduced needs, others, such as chemical processing, electronics, and emerging green energy applications, continue to draw on its unique catalytic properties. Jewelry demand, particularly in key Asian markets, adds another dimension, often responding to cultural preferences and economic conditions. When these strands converge with limited new supply, the market can exhibit sharp repricing, as observed in the extended rally that captured attention earlier in the year. This brings us to the potential ripple effects for silver. Silver shares certain industrial characteristics with platinum, serving in electronics, solar photovoltaics, medical applications, and more. Both metals benefit from their scarcity and physical attributes that make them irreplaceable in high-performance settings. If platinum's strength signals broader tightness in specialty metals, it could underscore similar pressures building in silver inventories. Global silver mine production has faced its own headwinds, with many primary and byproduct operations contending with declining ore grades, rising extraction costs, and community or regulatory issues. Recycling provides some balance, yet overall above-ground stocks remain sensitive to surges in fabrication demand, particularly from the renewable energy sector where silver plays a prominent role in photovoltaic cells. Market observers have noted that silver's industrial offtake has grown steadily, sometimes outpacing supply growth and contributing to periodic deficits. When viewed alongside platinum's recent performance, this suggests an environment where undervalued or underappreciated metals can experience re-rating as fundamentals reassert themselves. The gold to silver ratio, while a long-standing reference point, does not always capture these cross-metal dynamics or the macroeconomic backdrops influencing them. Factors such as currency fluctuations, central bank policies, and shifts in investor risk appetite can amplify movements across the entire group, stepping back to examine the wider economic canvas. The period since 2008 has been marked by unprecedented monetary expansion, technological acceleration, and geopolitical realignments. These elements have reshaped commodity markets in subtle yet profound ways. Platinum's long consolidation phase mirrored a time when industrial recovery was uneven and alternative materials or efficiencies tempered enthusiasm. Its breakout coincided with renewed focus on supply chain resilience, energy transitions, and strategic resource security. Nations and industries alike have been reassessing dependencies on critical materials, leading to heightened awareness of potential bottlenecks. For silver, this environment holds particular relevance. Its historical monetary legacy continues to resonate with those who view it as a store of value amid fiat uncertainties, while its industrial footprint ties it directly to innovation in electronics, electric vehicles, and sustainable technologies. As manufacturers pursue higher efficiency and performance standards, demand for silver in conductive pastes, coatings, and components may prove more robust than many anticipate. Meanwhile, investment interest, whether through physical bullion, exchange-traded products, or mining equities, adds layers of liquidity that can magnify price responses during periods of heightened attention. It is worth noting that platinum's price action did not occur in isolation. Broader precious metals sentiment, influenced by interest rate trajectories, inflation expectations, and safe haven flows, provided a supportive backdrop. Gold, as the anchor of the sector, has exhibited its own resilience, often serving as a benchmark against which other assets are measured. When gold maintains strength, it can lift the visibility of silver and platinum, encouraging capital rotation among them based on perceived opportunities. The interplay is intricate. A strong platinum market may highlight supply constraints that also apply to silver, prompting analysts to revisit inventory data, mine development timelines, and fabrication trends across the board, delving deeper into geopolitical considerations. The distribution of platinum resources underscores risks that extend to other metals. South Africa's dominant position brings exposure to domestic challenges including power supply reliability, union negotiations, and evolving mining legislation. Russia's contributions similarly tie into international relations and sanctions frameworks that can disrupt trade flows. These realities encourage diversification efforts by consumers, whether through stockpiling, substitution research, or investment in junior exploration companies targeting new deposits. Yet meaningful new supply often requires years to develop, creating windows where existing producers gain pricing power. Silver's geography is somewhat more dispersed, with major output from Mexico, Peru, China, and Australia, among others. This offers a measure of resilience, but it does not eliminate vulnerabilities, such as declining grades at legacy operations or competition for resources with copper mining, given silver's frequent byproduct status. Exploration success in silver has been mixed in recent cycles, with fewer large-scale discoveries offsetting depletion. Consequently, the market has leaned more heavily on recycling and existing inventories, which can tighten quickly if industrial offtake accelerates. From an investor perspective, these dynamics invite a mindset of patience and thorough analysis rather than reactive trading. Platinum's multi-year basing period, followed by its vigorous advance, illustrates how markets can reward those who monitor fundamentals over extended horizons. For silver followers, the lesson may lie in expanding the lens to include related metals and the industrial ecosystems they serve. Solar installations, for instance, have become a major silver consumer, with each gigawatt of capacity requiring substantial quantities. As global commitments to decarbonization proceed, even with policy variations across regions, cumulative demand could exert sustained pressure. Technological innovation also plays a dual role. On one hand, efforts to reduce material intensity, thinner layers in solar cells, or alternative catalysts could moderate requirements. On the other, overall expansion of end-use applications often outweighs efficiency gains, leading to net higher consumption. Platinum's experience in automotive applications where emission standards and powertrain shifts coexist, provides a parallel worth watching for silver in electronics and energy storage. Macroeconomic variables further color the outlook, with central banks navigating inflation, growth, and debt sustainability. Precious metals as a class retain appeal for portfolio diversification. Real interest rates, currency valuations, and geopolitical tensions all influence allocation decisions. In environments of moderate growth coupled with persistent fiscal challenges, assets with intrinsic scarcity and utility tend to attract attention during periods of uncertainty. Returning to the current juncture in mid-2024, wait, July 2026. Platinum's retreat from peaks allows for digestion of the prior gains while fundamentals continue developing. Inventory levels, futures positioning, and physical delivery patterns offer additional clues. Exchange inventories for platinum have fluctuated, sometimes signaling shifts between investment and industrial hands. Similar monitoring for silver reveals periods of drawdowns that coincide with strong fabrication or investment buying. For those engaged with silver, the platinum story serves as a reminder that interconnected markets can transmit momentum in unexpected ways. A metal dismissed as niche can suddenly illuminate broader themes of resource nationalism, technological demand, and monetary evolution. This does not imply direct price correlation at every turn, but it does highlight shared exposure to global industrial cycles and supply-side frictions. Expanding on historical parallels, the 2008 platinum spike occurred amid a commodity supercycle fueled by rapid industrialization in emerging economies. Prices across many resources soared before the financial crisis triggered a sharp unwind. Today's context differs, with more mature supply chains, greater emphasis on sustainability, and advanced financial instruments facilitating participation. Yet, echoes remain in the form of concentrated production risks and rising baseline demand from population growth and development. Silver's own history includes episodes of dramatic revaluation tied to both monetary and industrial factors. From its role in coinage to modern photography and beyond, adaptability has been key. In the current era, its conductivity and reflectivity ensure relevance even as new materials emerge. Market participants who study these long arcs often gain perspective that tempers short-term volatility with structural awareness. As we consider forward pathways, several themes merit ongoing observation. First, the pace of energy transition and its material intensity. Projections for electric vehicle adoption, renewable capacity additions, and grid modernization vary widely, yet most envision substantial metal requirements. Second, mining industry economics. Higher prices can incentivize investment, but permitting delays, capital costs, and community relations often slow the response. Third, investor behavior. Retail and institutional flows into precious metals respond to macro signals, with silver sometimes exhibiting higher beta to gold moves. Platinum's recent chapter underscores the value of looking across the periodic table rather than in isolation. It encourages a holistic view of the precious and critical metal space, recognizing that tightness in one area can spotlight opportunities or risks in others. For silver enthusiasts, this might mean paying closer attention to platinum group metal reports, automotive production data, and South African mining updates as supplementary signals. In synthesizing these elements, the market appears to be in a phase of gradual reawakening to the constraints and potentials inherent in these resources. Platinum's journey from obscurity to prominence and subsequent consolidation mirrors the kind of cycle that can unfold when fundamentals align with sentiment. Silver, with its unique blend of monetary heritage and industrial criticality, sits at the intersection of many of the same forces. While no single metal dictates the path of another, the collective pressure building across supply chains and demand drivers suggests an environment conducive to thoughtful engagement. Throughout financial history, patient observers who connect disparate threads have often identified shifts before they become consensus. The current interplay between platinum's tectonic movements and silver's enduring appeal offers fertile ground for such analysis. As global economies navigate technological transformation and resource competition, the quiet signals emanating from these markets deserve measured consideration. This perspective does not constitute guidance, but rather an invitation to explore the data, consult diverse sources, and form independent assessments. The precious metals arena rewards curiosity and diligence, particularly when viewed through the lens of multi-year developments rather than daily fluctuations. Looking ahead, continued monitoring of production statistics, technological adoption rates, and macroeconomic indicators will be essential. Platinum's story, still unfolding, may yet provide additional chapters that inform the silver narrative. In the meantime, the broader architecture of these markets, geological limits, geopolitical influences, and industrial innovation remains a compelling field of study for anyone engaged with the financial theater of our time. The conversation around precious metals evolves with each new data point and policy decision. By appreciating connections across the spectrum, from platinum's specialized role to silver's versatile applications, participants gain richer context for the developments shaping portfolios and industries alike. As always, the key lies in staying informed, maintaining perspective, and recognizing that markets often reveal their truths gradually to those willing to listen attentively.